And this brings us to two terms I've deliberately saved for the back end of this chapter, namely primary markets and secondary markets. The typical trading that you're familiar with from television or movies takes place in the secondary markets, meaning that existing securities, securities that have been issued and already purchased at least once, are traded on stock exchanges, and we call this the secondary market. In terms of concept, this is in contrast to the primary market. The primary market is merely the term for a situation where securities are sold for the very first time, meaning that a company issues, let's say, a stock or a bond, and the first time that a third party purchases this bond or share, that's referred to as a sale that takes place on the primary market. So how do shares and bonds find their way into the primary market in the first place? The answer to this is that companies regularly take advantage of the services of investment banks. A few weeks ago, when we were covering another chapter of Ebert and Griffin's, I gave a definition for a commercial bank, and in context of that, I mentioned that the core business of a commercial bank is to take deposits and to make loans, and a student of mine interjected and asked whether that wasn't the core business of any bank, and I said, no. And an investment bank is a typical example of a bank that has a different core business activity. Now, investment banks do a lot of things, but among their core business activities, investment banks help companies to securitize their capital. They help companies to sell stocks or bonds on stock exchanges, bond markets, etc. And they can do this in three different levels of commitment. First of all, an investment bank can act as an advisor to a company. All that means is that the investment bank provides a company that wants to issue stocks or bonds with advice on how to do this best. A deeper form of commitment takes place when the investment bank acts as an underwriter. Underwriting is merely another name for buying, and if an investment bank helps a company by acting as an underwriter, all that means is that the investment bank has agreed to buy some or even all of the new securities that the company wants to issue. This is done to guarantee that the company will find a buyer for its shares or bonds. And so the investment bank acts as a buyer and then resells these securities in the secondary market. Now, finally, an investment bank can help an issuer through its distribution services. If you were the owner of a company that wanted to issue shares or bonds, then one problem that you would face would be finding initial buyers. If an initial float or an initial sale of shares is to be successful, then you normally have to have a few committed core buyers in the form of investment funds, pension funds, etc. And investment banks generally have very good levels of contact to these different funds, and will help you reach them, usually in form of a roadshow in which the investment bank and yourself help to present your company and make it interesting for potential larger institutional investors. Now, whenever a company sells shares or bonds to the public, it's referred to as a public offering, in contrast to a so-called private placement. But if a company sells bonds or shares to the public for the very first time, then it's referred to as an initial public offering, or IPO. Now, let's assume you've decided to buy or sell a security. The first thing that you would do is you would approach your broker, who could be a full-service broker or a discount broker. But what you'd have to do is you'd have to give a placing order. And there's a couple of things that you need to consider. The first and simplest type of order that you could give is a so-called market order. In this case, you tell your broker to buy or to sell a security at whatever the prevailing market price is. And the advantage of this is that you're almost certain to be able to buy or sell the security. The risk is that you have very little control over the price. In the case of a limit order, things are the other way around. You order your broker to buy or to sell a security at a specific price, which is called the limit price, and this way you're guaranteed to buy or sell only at on your terms, but on the other hand, this order cannot be executed unless you find a counterparty, or unless the broker finds a counterparty that is willing to enter into the contract on those terms. In the case of a stop order, you instruct the broker to buy or sell a security once a certain trigger price has been passed. Now, this isn't the same thing as a limit order, because in the case of a limit order, you only buy or sell at a specific price. In the case of a stop order, once a price threshold is passed, you instruct the broker to buy or sell, and that might or might not be at the exact trigger price. It might be higher or lower. Finally, depending on our volume of securities, we buy and sell securities in either a round lot or in an odd lot. Round lots are always groups of 100, whereas odd lots are any number of shares or bonds that are below 100. The difference being important because brokers usually charge higher commissions for odd lots than they do for round lots, at least per share, per security. All right, towards the end of the chapter, Ebert and Griffin confront us with two more strategies that are used on securities exchanges, and they're related to financing security purchases or sales. The first is referred to as margin trading, and margin trading takes place whenever an investor buys stocks or other securities without spending the entire money that's necessary to purchase them, meaning that the investor buys securities on credit. The second strategy is a so-called short sale. In the case of short selling, investors expect the value of a security, such as a stock, to fall in the future. Let's assume that you expect that company ABC will report losses for the next quarter. Now, if it does this, you can be almost sure that the value of company ABC's stocks will fall, and you might want to capitalize on that. Think about it. If you were able to borrow a share of ABC right now from somebody, and you promise to return this share in 5 months, then what you could theoretically do is sell the share right now for the market price of, let's say, $50. And then, if the share really does fall in 1 or 2 months, you could buy the share back for, let's say, $30 and return it to the individual owner. And that is exactly what short selling is. You are betting on the value of a stock or other security falling in the near future. And because of this, you borrow a share with the promise to return the share in a few months' time or in a future period of time. You then sell this share for the current market price and repurchase a share later for what you hope will be a lower price. Now, this can be very lucrative, but at the same time, of course, it's extremely risky if the share doesn't lose value, but rather increases in value. Please continue by watching the next video.